All right, Mike, we're ready to go.
Okay, just a second here. All right, let's get started. Thanks everybody for coming out today. Glad to have you all out, and this will be taped. It'll be up there for all of you to see later on. A little cloudy day out there, so it's good to be inside. So we're with our great friends and partners at Rise Advisors out there in Coquitlam, who have been doing a lot of work in the community and been really busy lately, helping you all through, a lot of people through all this information that's going out there and all the turmoil we're going through. We got Hussain here. He's come back to talk to us about managing cash flow in times like this. It's very important, especially as we come back into business now, as we start to deal with your inventory and how many customers are coming back and the things you need to do to get ready, prepared to open business if you haven't opened already. So managing cash flow will be one of the key components, I suspect, moving forward. But I'll let the experts talk about that in just 1 second. Remember, the chambers, you can, if you're not signed up for our emails, get our emails every day that come out. Seems like the government's putting something out new every day, and we try to get out there as quick as you can and keep you on top of it. Take the mind reader surveys when they come out, because they do flow directly into the Premier's office and the Finance Minister through the BC Chamber. They get the information every week that comes out. They meet every Thursday, I think, Thursday night. So there's a new survey that's going to come out tomorrow. Remember to support the local businesses as we go through all this stuff. It's key as we get open that they get some cash flow going, as you're going to talk about. And remember, we're here to help you out. So without any further ado and any more commercials on my part, I'm going to turn over to Hussain from Rise Advisors to take us through the webinar. Hussain, over to you, sir.
Thank you, Mike, Stephanie, and everyone at the Chamber for the warm introduction. And thank you all for joining for today's webinar. Now more than ever, as Mike emphasized, it's so important that we come together as a community to share knowledge, to help one another retool and reskill, and collectively kind of prepare ourselves and build ourselves up to not only survive what's going to be the next few months and years, but to accelerate and establish growth despite the current conditions. So, you know, as business owners, over the past few months, we've been forced to significantly pivot how we run our business and have had to evaluate how it is that businesses will survive in the post-COVID economy. Ultimately, the goal has remained the same, that owners want to ensure the continuity of their business, protect their employees, their customers, and their key relationships. So our goal today is to provide some clarity and some suggestions around managing your working capital and cash flow, and also to clarify what as business owners you could be considering today and in the next few months to better set yourself up for success. Our agenda for today will be as follows. So we're going to actually jump into the importance of data in evaluating your working capital to begin things. We'll go through the management of working capital, including the effective use of AR, AP, inventory, and managing credit. And while it's not an exhaustive list of items that can affect your working capital, these key items alone can have a significant impact in themselves. We're going to do a quick recap on some of the benefit programs from a corporate perspective, especially in light of some of the changes that have happened in the last few weeks. And then if you recall from our first webinar, we presented a timeline of what the summer would look like for a lot of business owners from a cash flow perspective. We're going to revisit that timeline and an update for some of the changes and things that individuals and business owners should pay attention to as they work their way through the summer. From an introduction perspective, my name is Hussain Haji. I'm a partner with Rise CPA. We're a full service accounting, assurance, and advisory firm focusing on business owner compliance and planning based right here in the Tri-Cities, and we're a longtime partner of the Chamber. So when you think about it, Canada itself has continued to experience circumstances never seen before. The economic climate has led many business owners to make difficult decisions in a very short time frame, many of whom weren't ready to make such decisions. The federal government, you know, has offered a stimulus package that is providing benefits that have never been seen before in the country. So whether it was originally through the Canada Emergency Response Benefit, the Canada Emergency Wage Subsidy that a lot of business owners were eagerly anticipating, and the first of the payments have now started to come through. The federal government has really been offering incentives to ensure that all Canadians are supported, jobs are protected, and that businesses can hopefully manage and survive as we return to some level of normal. Prior to the pandemic, from a business owner perspective, rising costs and labor markets had already been challenging, and things have just exponentially become more challenging given the current climate. I've said this before, but on average, small businesses prior to the crisis were said to have had cash reserves ranging from 30 to 60 days. The current conditions have demonstrated again that we have a liquidity issue. And so from a business perspective, we have decisions to make that will focus on injecting and retaining cash flow, but it also presents a great opportunity for us as business owners to build the systems, to evaluate the data, to set the metrics and have the conversations with our customers, our vendors, our employees to redefine key relationships so that you can set yourself up for success. So when we think about managing cash flow, it all really begins with having measurable data. Many companies don't systematically track or report data on working capital. That almost always indicates an opportunity for companies to improve. So for example, if you think about managers at a manufacturing company who can't quickly determine how many days their current inventory will last them from a production perspective, it becomes difficult to manage that production. If we don't have readily available data on how much we spend with our suppliers and the respective payment terms, then it becomes challenging for us to manage our accounts payable and our cash flow. So when it comes to data, owners and managers could be making decisions everywhere on inaccurate information and making good decisions, particularly with respect to our working capital and what our outlook looks like. It all begins with good data. So in times like these, business owners should be asking themselves important questions such as, what should I be measuring? What should my systems look like? And how do I take the necessary steps to ensure that I can evaluate my business operations in the way that I need to in order to make those effective decisions that I need to make? So, getting that data for the first time, it can be really tedious. You sometimes have to integrate a lot of different systems, particularly legacy accounting and information systems, but it's such an important part of the requirements in evaluating your working capital effectively and in a timely manner. And we can't stress how important that can be to the overall strength of the company. So if your current system is unable to accommodate or transition your business in a way that changes can be made right now so that you can start to evaluate this data, it's really important that we do that right away so that we're best set up for success in the coming years. You then need to take the measurable data and modify your metrics to increase transparency and visibility throughout the organization. So working capital is often undermanaged simply because of a lack of awareness or attention, particularly at the production level. It may not be tracked or published in a way that's transparent or relevant to employees, or it may not be communicated as a priority. So when you think about it, working capital is often underemphasized, I should say, when you think about the performance of the business, where typical metrics and performance-based measures include gross revenue, gross profit, EBITDA, which don't often reflect the changes in the working capital that we want to evaluate. So imagine if we started to measure based on how quickly our customers are paying us, or how effectively we could renegotiate payment terms with our vendors, or if we were able to navigate the waters where we collect before we have to pay out. So the question becomes, what actions should managers be taking beyond communicating simply that working capital is important? In our experience, the selection of a key metric or the right metric to manage the business and measure performance is especially important because a different metric will lead to a different outcome. Are you evaluating your working capital on a regular basis? Do you measure against yourself and your history against your industry or an industry benchmark? Do you communicate that working capital is important and retention of cash flow is important throughout the organization, and reward your managers and your staff for having those types of behaviors and buying into the strategic vision of the company? Like there's an example that comes to mind where there was one manufacturing company that typically had done their performance measurement based on earnings, and they switched from EBITDA to cash flow as a measure for performance. And it had an immediate effect because managers began to measure the cash flow now at the plant level. And inventory metrics were distributed based on working capital metrics as opposed to performance-based indicators such as profitability, where typically now your plant managers and your internal supervisors started to buy into the different processes of the plant, and they were able to conserve cash flow because they started to evaluate how quickly they were able to translate their production into good cash flow management. So when you supplement your operating metrics with metrics specifically geared around working capital, it can allow you to make those holistic decisions and review your business in aggregate. You then need to start to actually, if you can just go back to the previous slide, you need to set more meaningful targets. Because even when the data is available, managers need to set performance targets that are they often set performance targets that are based on history or conjecture rather than analytics. So you've seen in many situations that an inventory manager, for example, will create a target level based on gut feel or what feels to be right, rather than looking at the history and the pattern of what production and demand and supply for the products have actually been. Often we find that successful managers of working capital can recreate the business process as if there was no constraints in place whatsoever. And that's referred to as a clean sheet approach. And yet leveraging that opportunity can really shed some light on how to reevaluate how the operations are actually being done. So managers, for example, at one company typically had held 60 days of inventory on average. The concern was that they wouldn't have enough inventory to be able to process the orders that were coming through. In that example, when they were asked to improve performance, the managers then set the initial target of cutting back to 50 days, and they had already felt that that was overly aggressive. They decided to explore with the work of the owners to explore a clean sheet approach. So they now took away all of the barriers and the disruptions, and they imagined it in a perfect world, what would life look like if we did it in there? And then they introduced a few buffers based on the actual variability, because they were forced to determine, where does the variance happen in the supply and demand? Are we seasonal in our business? And in the end, they had determined that only 30 days of inventory was actually needed. So the reduction not only saved them significant amounts of cash, but it also streamlined the operations and the ordering significantly. So it's just one example of how setting a meaningful target can lead to a good outcome. And then the last thing we want to say on data is essentially you need to continue to evolve, you need to grow, and you need to continue to change. So once you have the data and the targets in place, we can then turn to more advanced techniques on managing our working capital effectively. So, when we think about effective working capital management, it cannot be done without good data. So we need to firstly determine what it is that we're measuring, what is relevant in a holistic way, and in a perfect situation, what should our systems look like? Take the time now where we may have additional capacity to reevaluate what those metrics are, and we're forced to reevaluate our operations anyways. You don't need to implement a very costly system. That's not something you need to do, but you need to just take a step back to evaluate what are the key metrics and build the simple steps in there from a business perspective that you should be measuring that you may have not historically measured, and supplement your operating metrics with working capital metrics, as it can have monumental impacts on your business. So if we think about it now, let's imagine that we do have the data, we do have the metrics, we have the dashboards in place. What do we do if we're still facing that cash flow crunch, particularly given the current circumstances? So we want to focus on four main things, which is the management of accounts receivable, inventory, accounts payable, and credit, and general leveraging within the business. And this, again, is not an exhaustive list, but these few things can make big impacts on your business. So it all starts with accounts receivable. No matter what business we're in, collecting our receivables as soon as possible is key in order to maximize the cash that we have in the business. Our goal is to basically take the materials that we have, turn those materials into products and inventory, and then turn the inventory into a receivable and collect the cash. So when we think about tips and tricks that we can start to employ that maybe we haven't historically, is invoicing clients promptly. The less time between the actual sale and the invoice, the sooner you're going to get paid. If you have contracts in place with your customers, make sure that you outline payment terms and it's agreed to by both parties, and hold the parties accountable to that. If you're an individual that provides services in the field, think about using point of sales tools like Square and PayPal. There's so many good tools in place so that you can collect your receivable or your cash in the field. You might have to pay some small transaction fees and explore the options that are available to you. But by using these methods, at least you're ensuring that you collect your fees immediately before you even leave the site, particularly if you're facing cash flow issues. when you have a new client or when client credit is an issue, get those bank confirmations and the credit checks done. You can ask for cash in advance. It's a routine practice and it's readily accepted. Especially like when it comes to new clients, we always celebrate the success when we're getting new customers and new clients, and there's this fear to ask for too much upfront because we might lose that sale. But not performing the required due diligence can lead to significant problems down the line. So take the time to do that, and take the time to really speak to your customers. You know, the COVID crisis and the pandemic has introduced, you know, an opportunity to redefine our relationships with our customers, our processes, and redefine truly what those expectations are that we have of one another. Everyone is going through something. There's some impact to every business out there today. And so individuals are certainly, you know, we've found are being more understanding, they're being cooperative, and together in a transparent manner, if we can speak to one another, we can have great results in redefining what those relationships look like. Ensure that you're reviewing your aging on a regular basis. Ensure that your collections department, whether that's an individual or if you're larger in terms of your organization and you have a department, make those calls and don't procrastinate with delinquent accounts. Like, start to get on top of those collections. Early payment discounts are something that's not often explored by a lot of businesses, but it's a great way to get cash into the business. You might earn a little bit less because you're providing that discount, but particularly if you're using an operating facility where the spread between the interest rate on the facility that you're using versus the discount, it might actually end up improving your cash position overall. And then the last thing that often is not explored is factoring invoices. If you've kind of explored all other opportunities where instead of waiting the 60 days for a client to pay, for example, you sell the invoice to a factoring company. But again, this isn't an exhaustive list, but it gives you an opportunity to start thinking about having good, consistent AR practices, because they're so critical to the collection of your cash flow. And now is the time to redefine those relationships and those processes and evaluate appropriately. So when we think about after we're done with AR, we kind of shift into inventory, which can be a big cash expense for most companies. And there's a fine line between having too much inventory and not having enough, which is often the concern around production. So more likely, the real thing is that if you can analyze the trends in your inventory, establish good forecasting, and purchase inventory around patterns that you've clearly articulated and in an analytical way you've evaluated, it becomes like that example that I gave you earlier about the 60 to the 50 to the 30 days about, you know, how much inventory do I truly need in my business? You can enact just-in-time inventory, where you basically buy inventory as close as possible to the sale date, and that becomes critical as far as understanding what your sales cycle and your production cycle look like. This might mean that your product is kind of almost made to order, and you might result in slightly less margin, but it might help your overall cash position and conserve those key resources of cash in the businesses. Buying more because it's cheaper is not always the best strategy, particularly if you're buying something that doesn't turn over very, very regularly. Paying a bit more for inventory, but buying less of it can be a lot more efficient from a cash management perspective. Think about obsolete and dead inventory as well, and sell that at a markdown before it becomes outdated. And in some businesses, that could be 3 to 6 months. But the longer that you hang on to inventory, particularly that has, you know, a shelf life or an obsolescence, the more difficult it becomes to sell it. Drop shipment is something that, for those that are selling physical products, has become a new trend, where basically it goes directly from the manufacturer to your customer. And it really makes sense for lower demand products where you know, the concept of physically buying the inventory, bringing into your warehouse, taking on the necessary overhead and the transportation costs can actually result in overall reduction in margin. So it might be a good strategy for many of you that can explore it. The third area of working capital I kind of wanted to explore was accounts payable. And understanding and using your payment terms is key to managing your accounts payable. So again, like I said, redefining your customer relationships it's a great time for you to redefine your vendor relationships right now. Negotiate your terms so that they meet your needs. Have those transparent conversations with your vendors, particularly if they have a good relationship with you. Extend out those payment terms if you can. Don't pay early only pay when the payment is due if you need that extra time. They're in the same early payment discount. You might be receiving those, but make sure you proactively evaluate your cash flow in a proactive way and foreshadow what the rest of the year looks like, and stretch out some of those payments if you need to, particularly if you're experiencing some decline in business. If you're going to be renegotiating or you have vendor contracts in place and they're coming due in the near future, try and renegotiate and extend those terms well in advance, because you might have the ability to renegotiate lower fees. If you wait till the end, your negotiating power is significantly lower than if you do it well in advance. And the good thing about from a vendor perspective is that they're guaranteeing their revenues and their contracts going forward. So they're often amenable to exploring renewal well ahead of the timeline. When you're in a position to, or if you're going to be making significant cash or capital investments in the coming months, explore the idea of minimizing the down payments, stretching out the monthly payments, leasing where you've typically purchased. In addition to not only the cash savings, there's some great tax benefits. So speak to your advisors, as there's been some changes around accelerated depreciation, and there's some elections that you can make, particularly around leased assets, that as long as the leasing company is willing to work with you, you might be able to leverage the tax benefits of depreciating that as though it was your own asset, even though you're leasing it. So again, a great cash flow savings and tax measure. So speak to your advisors on that. The last thing when it comes to accounts payable in general and purchases is watch your expenses, right? So in the event that customers aren't paying as fast as you need to, you could explore the idea of delaying your expenses. The strategy can take on many different kind of ways depending on the company that you're in. But for example, a manufacturing company could explore using lower cost inputs. I know supply chain is stretched right now given the current conditions, but lower cost inputs, or if you're in the service industry, then can you spend slightly less time? Can you evaluate how long it takes you to do your actual work? Consider, exhausting existing inventory resources or repurposing inventory that you have or raw materials as opposed to purchasing new inventory. Can you hire part-time or contract employees, especially in the gig economy right now that we have, to replace the full-time ones? It's all about evaluating what you need for your business and what makes the most sense. The last area that I want to touch with, and it really dovetails into the last section and the benefits, is around effective leveraging and use of capital. Just go back for a second there. Most businesses will run into cash flow problems at some point, particularly in an environment like we have now. And a strong company is able to fund their current liabilities through current assets. So, ineffective cash management or lack of resources can lead to debt requirements to fund the current liabilities, let alone long-term ones. So spend the time now while you have it to get a sense of what the rest of your year is going to look like. Leverage and have those conversations with the banks and your lenders to ensure that the solutions that you have in place, the facilities that you have in place, are appropriate for your business and what you're going to need. If you think about the major expenses that most businesses have, it all starts with wages and our people. It's our rent or our mortgage. And many of the programs and deferrals that are in place now are starting to manage those expenses. So whether it's the emergency wage subsidy, the 10% subsidy, in case you've had a decline in business, the mortgage deferrals for those that own their real estate, the commercial rent program that's going to be launched on May, or the application opens up on May 25th. Leverage those programs to buy yourself the time, but ensure that you at the same time be proactive about managing your leverage and your capital and your financing, and have those conversations with your banks so that you're ready to grow and take advantage once we get past the deferrals and once all of these fundings that have been provided as a result of COVID-19 run out. So leverage the time now, use the programs that are in place now, and think about your leverage and your capital solution in a holistic way, being proactive rather than reactive. Evaluating your company and your leverage model on a continual basis is so important. We always recommend, and it shouldn't be ignored. Leveraging your business appropriately is also critical in case, for many of you, you're thinking of selling your business in the future, because the ability to demonstrate to a potential buyer that your business can be financed is critical to help through that due diligence and that sale process. Remember, like right now, our goal should be to evaluate, rethink our business model, leverage, and retooling in a holistic, integrated way. It all starts with effective use of data, effective systems from capturing it to evaluating it. Work with your advisors to think through some of the long-term strategies that you have and leverage appropriately. Renegotiate and redefine those relationships that you have with your customers, and redefine that with your vendors. We again should be evaluating, rethinking, and retooling our business model. So I wanted to kind of dovetail into some of the benefit programs that we've seen. So it's actually right there. So we know that a lot of the programs are already in place, and a lot of the business owners are leveraging them as best as possible. The 10% emergency wage subsidy, the 75% CEWS, or the emergency wage the big wage subsidy, which has now been extended through the end of August. The emergency business account, which is the $40,000 interest-free loan. There was an update that came out yesterday to expand eligibility. So if you haven't explored it, or if you still have questions, reach out to your advisors, reach out to us at any point in time. Happy to walk you through it. You have through the end of September to apply for the wage subsidy, and the business account is now, it hasn't been legislated, and there's going to be more information that comes out, but it looks like individuals that paid themselves through dividends as opposed to payroll, which was the limitation before, has now been expanded. The commercial rent assistance program, that the applications will open up in May for that. So explore your opportunities there. And we know that through the last several months, individuals have been taking advantage of the tax deferrals. So if we go to the next slide, for those that recall our first presentation, what we had done was kind of come up with a preliminary timeline of what life looks like at that time, which began in mid-March. So when we think about May, what's happening right now, and what could we do as business owners to think through our cash flow? Really, the first of the payments on the emergency wage subsidy came through earlier this month for a lot of individuals. CEBA has been expanded, so if you haven't taken advantage, that's something you can do right away. A lot of our service providers, so BC Hydro, ICBC, are offering deferral programs, so take advantage of those. For those that are in a rent deferral or are able to renegotiate their commercial rent with their landlords to that 25% limit, we're going to have potential commercial rent assistance through the next few months, opening up in May. For those that are landlords and whose tenants aren't paying them, that's certainly going to be available to you if it makes sense for the business. When we move our way into June, you know that the GST payments were originally deferred through there, so things are going to start coming due. Personal tax deadline is coming up in a week, so ensure that you don't file late. The filings haven't actually been extended further than June. The payments are, but you'll have ensure that you file appropriately. Some of the deferral programs are on BC Hydro. If you leveraged them back in March, those are going to start to come to an end. So from an expense and a cash flow perspective, it's going to start to return to some level of normal. So again, this comes back to revisiting our leverage, our capital facilities, and what we can do to manage for the next few months. And for the December filers, the corporate tax deadline hasn't been pushed, so that's coming up at the end of June. If we look at August and September, a lot of the deferral programs and the corporate tax deferrals, those will start to come to an end. We know that CEWS has been extended through August. So remember that there's going to be some level of government support being offered, but pretty much at the end of the summer is when we start to get back to normal. So again, use the time now, evaluate the data, revisit kind of what your key metrics are, manage the cash flow in a proactive way, build in the system so that you can proactively kind of plan through the rest of the year. Look at those three key cycles around your sales and your receivables, your purchases and your payments and your payroll, and how we can leverage cash flow and build in supports for ourselves so we can manage appropriately through the end of the summer. But that's kind of what we really wanted to touch with, give you some tips and tricks on what you may or may not already be doing, leverage the existing programs that are in place, but really have those conversations about leveraging your company appropriately so that you're set up for success as you come out of that.
All right. Thanks, Hussain. Really appreciate that. Tons of good information there. I'm just trying to digest some of it myself. So if you got a question, please enter it on the chat. Click the chat at the bottom of the screen there and enter your questions in there. No questions too big or too small to be answered. So lots of good information there. As you said, the government's changing their programs almost daily, it seems like. Yeah. But the positive thing I would say is they are listening. I'm on a call most mornings at 8 o'clock with the feds back east, and they are taking the feedback we're giving them, and they are trying to make adjustments accordingly, as we saw with the SEBA, and now that dividends look like you'll be able to get some support there. So they are listening, and they are trying to make adjustments as we go along. From what
Yeah.
I've seen.
Yeah, no, for sure. I think, it's an iterative process, and we didn't know in the middle of March how long this situation was going to go on for. So, I think it's something that's going to be fluid. It's going to be dynamic with a lot of the provinces reopening over the course of the next couple of weeks. It's going to be a learning experience for many people, but I think it presents a great opportunity. While it's been difficult for a lot of business owners, there's some great opportunities to repivot and retool as well.
So you talked a lot about metrics. What are some of the metrics you think people should be looking at?
Yep.
Specifically, if you can.
Yeah. So like if you think about working capital, then the traditional metrics really are your current ratio, which is typically your current assets divided by your current liabilities. That gives you a real clear indication, just as a starting point from a working capital perspective, as to are your current assets in a position to pay the liabilities that you're going to have for the coming years. So, when you look at working capital, there's the current ratio to begin with, evaluating, amongst your receivables. You keep a key dashboard. I think dashboard reporting is so important around, are you looking at, when you look at your aging report of receivables, are we sitting in a bucket where things are very current and our customers are paying, or do you have these long-term receivables that just have been lingering for a really, really long time? Because then your current ratio is kind of skewed by older receivables that don't actually come in, right? So that it all starts with the balance sheet metrics of your ability to service your debt, to evaluate what's coming up in the next year. The operating metrics are always key, evaluating gross profit, evaluating gross revenues, your net income, but gross profit if you're in a business that has several product lines, it's always good to get granular down to the contribution, we call it, or the ability of each line to generate profit, as opposed to looking at holistically. A lot of businesses look at it as a whole. And when you get more granular as to the different lines of service or product that you offer, you can get some great insight into things that you might not know. So it might be the highest volume product that you have, but it's such a low margin, but it actually contributes quite a bit to the business, versus something that has a great margin, but you're selling so infrequently, and the cash outlay is something that you might want to explore not doing anymore. And then one of the things that a lot of businesses don't often have the time or the ability to do is that proactive. So while the balance sheet metrics or the ratios there kind of look at the historical past or where we sit today, the operating is telling us where potentially from a production and a sales perspective where we're going to be, and then what's our pipeline look like? Do we have established contracts? Do we have sales forecasted? Do we have the ability to grow and where we're going to be? So you kind of bring the three together, and that's what we always propose a good dashboard looks like. It's like, what's the whole pipeline look like? Because if I can't guarantee sales in the future, and a lot of businesses can't because we might be retailer or something that we just can't foreshadow, then are we doing the correct work to forecast our customer demand? Are we repivoting? Are we creating niche products for ourselves? So it's kind of the whole spectrum is the way I do it, but it all begins with that current ratio and just evaluating your ability to service your current and your long-term debt.
Cool. Got one question here asking about the wage subsidy. Is the requirements changed? You still need to show a 30% decrease in revenue. And my understanding is currently it still stays 15% for March, and then 30% from then on.
Yep.
But there is discussion about, I'm hearing there is discussion about
in the first month
of September about adjusting that.
Yeah.
Because what I hear, a lot of people not as many people taking up the offer as right now is what I'm kind of hearing.
Yeah. So I think and that's my understanding as well, is that nothing's changed from March being the initial 15% decline, the metrics being against your historical past versus the January, February. Nothing's changed from that perspective. A lot of individuals haven't necessarily been in a position to take advantage because, again, it came back to data and their inability to actually have the numbers to substantiate. We know that, the government came from a perspective that, there will be penalties and review of these things and audit at a subsequent period. So there's some hesitation and fear, and individuals have until the end of September to apply for this. So a lot of individuals have just been waiting to get their records together. But the big thing is, from a reporting perspective, I haven't seen anything that has suggested a reduction yet.
Yeah, I just heard that they're reviewing it given everything that's going on, maybe for the period of June through September, but nothing's been announced yet. It's just
Mhm.
conjecture on my part.
Yep.
Don't quote me on it. Cool. Any other questions out there, folks? Please don't hesitate to put them in the chat column there. We'd love to hear more about what you wanted to hear. Just talk a little bit more about accounts payable and how you can spread that out over time if your cash flow is a little tight. Some of your couple of your best practices there.
Yeah, I think it comes down to transparency and understanding kind of what is really, it comes down to what is coming due, right? Having a conversation with your vendors. If you're a key customer of that vendor, there is going to be some dependence from their perspective as well. So, stretching out the payments until they're absolutely due, exploring kind of contractually what the impacts of a late payment truly are from your vendor perspective, because you never want to delay something that will potentially cause a problem down the line, and they will cut you off, especially if you're working through some vendor financing. So I think what it is best practice would be, a lot of individuals have vendor contracts in place they haven't read through the fine print in a very, very long time. So re-looking at that and evaluating kind of, can we redefine that vendor relationship? That's the first one. Can we use some form of vendor financing to stretch out our payment as opposed to using our line with the bank, right? Is there an early payment discount? We flip it. Is there a benefit to you paying early? Have you negotiated an early payment discount? So as well, if you have the cash flow and it's something that you've historically done, can you at least take advantage of a practice you don't intend to change?
So it's about relationships with your vendors too. You
I
talk
think
about
so.
relationships all the time throughout your presentation there. It's about relationships with your customers and relationships with your vendors and establishing those and redefining them now.
Yeah, exactly. And there's going to be situations where vendors, aren't necessarily open, or they're not in a position to renegotiate terms. And that's when you need to then get into, okay, what does my cash flow from a business perspective truly look like on a month-to-month basis? And do I have the systems in place to even understand or make that judgment? And if not, then we should be having that conversation with our advisors and our banks to build in the facilities in place.
Yeah, but better to have those conversations when you need to, but than not have them and have to have a tougher one down the road. So
yeah,
better know where you stand, I think.
Yeah, exactly.
Another question's come in. What are your thoughts about keeping liquidity in your business versus working off a line of credit?
That's a very, very good question. So, as long as from a perspective, it's what are you doing with that cash if you're not using it, right? It's about leveraging that cash appropriately to either sustain your business, grow your business. Because at the end of the day, if you're using a line of credit and there's an expense associated with it, what's the expense going to do from a business perspective? Sometimes having an interest expense and going into your line is not a bad call, right? If it's particularly at a low cost, then why use the cash reserves? One of the things we had said to a lot of businesses is take advantage of the deferral programs, for example, but retain a good working list of everything that you're not paying so that you know exactly what you're going to need to pay at the end of August. So maintaining cash reserves is always a great thing in a business. Revisiting your leverage model to ensure that, if you're not leveraged appropriately. So let's say you have a line of credit and it's a low interest line of credit versus a line of credit that's sitting at a significantly higher rate than what you're seeing come out these days. Then it's about reevaluating to ensure that it's the lowest cost leverage that you possibly can get. Conserve the cash resources, but sometimes, if you're doing high volume, going into your line versus using your resources might not be the best. It might be costing you quite a bit. So it's about that management. Some individuals just really feel much more comfortable keeping the cash in the business, which isn't a bad strategy. It all depends on what the long-term plan is.
So just on that a little bit, and I got another question here from Scott online, but just cash reserves for emergencies. What's the rule of thumb? How long should you have? And given what we just gone through, people are going to reevaluate that drastically.
Yeah.
But is there kind of a rule of thumb? Should you have 2 months? What should you have?
So most businesses, were said to have, 30 to 60 days. The rule of thumb that at least like we believe in is typically 3 to 4 months is what we've historically said. If you've structured your business to if you have a family trust in place, you have a holding company, and you've kind of structured it in such a way that you pull out that excess cash and you can loan it back to the company, that's a great structure and a great model for you to have. But generally, we've said 3 to 4 months. Now, COVID has kind of tilted everything on its side. So whether it really comes down to what your business needs to survive and to grow, but 3 to 4 months was the typical benchmark prior to the pandemic. And now you're probably looking at, 5 to 6, depending on how you anticipate business returning to normal in your industry.
And that's the big question, isn't it? How is it going to return to normal? Nobody knows. I'm seeing all sorts of projections for Q3 being really a real bounce back, but all depends on how the virus plays out, and
Exactly.
see how it goes. But
every industry is going to be so different, right?
Yeah,
So,
there's winners and losers, and so just be prepared next time, folks. I think this is a wake up call for a lot of people. We probably weren't as prepared as we should have been, but this is a great opportunity to prepare, get your emergency plan ready. That includes your financial emergency plan for when the next emergency comes, and something will come at some point in time. Scott online is asking, can you confirm the temporary 10% wage subsidy is deemed to be taken by CRA and must be reduced on the wage subsidy 75% claim?
Oh, yeah. So
any info on when the 10% will be credited back if not claimed?
they haven't said. Yeah, when you work, he's working through the mechanics. It's a good question. It's when you're working through the mechanics of the 75% application. The way that the application is laid out is it's deemed to have been taken if you're eligible for it. And even if whether you've applied for the 10% or not, then you're said to have taken it, and it reduces the 75% payout if you would have been eligible. If you chose not to take it, my understanding is at the end of the year when you file your taxes, like your T4s, that's when it would potentially be credited. But there's been no guidance as to like how long it would take to get it. So our recommendation is that if you haven't taken it and you're eligible for it, you might as well do it right away, because it's actually going to be reducing your 75% as it is.
Good advice. I'm trying to figure out whether we're eligible for any of those subsidies, the 10%, the 75% anyways. Listen, any other questions out there, folks? Quickly put in there. Scott, no, I think we're good. We just answered that one.
Again, we're here. We're here. You know where we are. We're if at any point in time following this, if a question comes up, then feel free to reach out at any point.
Yeah, put the contact info up there again if you can. There you go. Rise Advisors, they're up on Lougheed there by North Road. That's where they are right now by Joey's. That's the landmark that most people go by. So, and they got a full staff, full team out there that can handle all your accounting needs, big or small. Lots of good people up there. One of the good cup firms in the Tri-City. So we thank you very much for everything you've done, Hussain. Thanks for everything, and keep up the great work as usual, everybody. If you've got any questions or anything you need from the chamber, please give us a call or email us. We're working hard to get information out to you as quick as we can. We do have Service Canada and CRA coming up on a webinar next week, I think, Steph. So we've got CRA coming up, and we're working with WorkSafe right now on setting up a webinar for them to talk about some of the guidelines they've laid out. So hopefully we'll have that up ready to go by early next week. That's the plan right now. So WorkSafe, CRA, and Service Canada are coming back. So we've got all the pros coming. We're working on a few other things. Check out the email that just got sent out to you today. Thanks, Hussain. Thanks to Rise Advisors for all you do in the community. Have a great day out there, and please contact us if you need anything. Have a good one.
So thank you, guys.